Hi, Jeremy here, talking about what the stock market is. Stock means ownership. If you have stock in a company, it means you own part of that company. The reason it's called stocks is rather funny. In England, the stock market started hundreds of years ago in a building right next to a meat and fish market. Featured at one end of the market was a bunch of criminals placed in neck yokes, otherwise known as stocks. You know, the planks with the holes in them for hands and a head to publicly punish criminals. That meat and fish market came to be known as the stock market, where you will find folks in yokes while buying your wares. The word stock itself goes back to meaning wood or tree trunk in like Latin or Old English or something. But this building in which people traded shares of companies happened to be right next to the stock market. You know, the market where people bought and sold meat and fish and people were stuck in neck yokes. So the building itself came to be known as the stock market building merely by association with its neighbor. Eventually, and because of this, the word stock came to mean ownership. And all over the English-speaking world, we now call it stocks. Stock market people stereotypically live agonizingly stressful lives, so I think it's rather hilarious that the derivation of the title of that field comes from a torture device. Stocks have been traded for thousands of years. Evidence of shares trading was found in pre-Roman Italy and other totally disrelated parts of the world. Stock trading is apparently a natural behavior for man. Beavers make dams, moles dig holes, birds make nests, humans trade stocks. To obtain money, a company can sell pieces of itself to people and increase the number of owners of that company, giving those new owners a chance to get paid part of the profits of that company. Those owners also financially benefit from an increase in value of the company as a whole. In the United States of America, the largest stock market exists in New York, managing over $30 trillion. Stocks used to be traded by pieces of paper being carried around by people called brokers on horseback from one place to another, peddling shares for profits between investors and shareholders. This was the wild, wild east of stock trading. It took place for the most part on the East Coast. Stock shares could get lost, rained on, forged, and lied about fairly easily, and so required regulation in order for the ability to buy and sell shares to become standardized. Brokers would help investors and shareholders trade their stocks and would receive commissions in the process of doing so. Finally, a group of these brokers got together on a dirt road called Wall Street in a region called New York. Under a buttonwood tree, they signed the initiation papers of what is now called the New York Stock Exchange. At that time, it was an assembly of brokers sitting in chairs or seats and auctioning off their stock in a more regulated, sensible arena. Each broker had a seat on the New York Stock Exchange. At that time, it was an actual chair. Help the channel by hitting the like button and it'll help more people get this vital knowledge. Access to a seat on the New York Stock Exchange to allow one to be part of the trading has been an envied position since day one in the 1700s when this was formed. To this day, there are hundreds of seats held on the New York Stock Exchange, giving a broker or brokerage access to buying and selling their clients' shares to other clients or other brokers or brokerages directly. A broker is one who buys or sells on behalf of another. A brokerage is a collection of brokers organized into a group, company, institution, or firm. The word broker itself comes from the French word bloquer, which means someone who puts a spigot in a barrel of wine to facilitate its consumption. The broker would be the one who installs the spigot and pours the wine for the client, much like the stockbroker facilitates the transaction of buying or selling shares on behalf of clients to hopefully drink the wine of profits. For a company to have its shares traded on a stock exchange, it must go public with an initial public offering, an IPO. This simply consists of a company getting appraised by an institution, then dividing itself into thousands or millions or even billions of pieces, then offering to sell these pieces for whatever the value of the company is, divided by the number of pieces there are. If the company was valued at 20 million and divided itself into 1 million pieces, each piece would be worth $20 during the initial public offering. After those pieces, called shares, are sold, there are now thousands of new owners to this company, and the old owners have a bunch of cash, which is mainly why they did this to begin with. With this cash, they can pay off the original investors, they can pay themselves, they can reinvest in the company to make it grow, and make whatever shares they still have more valuable, as well as making the shares owned by the new shareholders more valuable. As the new shareholders sell their shares to others or buy more shares of other people's, each transaction amount is displayed on what is called a ticker. The ticker is the last transaction price for a share or shares of a company. If the company's share price is $20 and a single shareholder sells one of his shares for $25 to someone, the ticker will display the number 25 as the new share price. It is called a ticker because these share price values that would change all the time were on a machine that made a ticking metallic sound whenever the number changed. Brokers facilitate these share price purchases and sells. Nowadays, 99.9% of all trades are done electronically through automated brokerages and computerized buying and selling. This has been the case starting in the 1990s. There are hundreds of brokerages that have seats on the stock exchanges. Each of these brokerages manages anywhere from millions to, in some cases, trillions of dollars of their clients' money that is being used to buy pieces of ownership of other companies in an attempt to estimate which companies are going to increase in value in the share price and buy those companies' shares. And then after this company's shares price goes up, try to sell them to others for more than they bought them. Try saying all that in one breath. Sorry for the run-on sentence. I was just trying to describe the whole action in one shot. Rewatch it as needed. Because the overall value of the stock exchange goes up by several percent every year, overall value of the stock exchange is positive. But that does not mean that all investors profit in the stock exchange. Day traders have the worst record of success of anybody. A day trader is somebody who buys and sells within the day in an attempt to guess small jumps or drops and play those. There are thousands of symbols, indicators, gadgets, machines, bots, algorithms, methods, techniques, professions, experts, courses, theories, studies, and jobs connected with the stock market. The basic idea is founded upon the owning of a piece of company and getting losses or rewards connected with that ownership. All other things derive from that concept, whether severely abstract and hard to understand or simple and straightforward. Many countries have their own stock exchanges. There's a London Stock Exchange, a Tokyo Stock Exchange, Chinese Stock Exchange, a German Stock Exchange, and dozens of others. Each of these operates similarly, and many of these individual stock exchanges interact with the New York Stock Exchange. The New York Stock Exchange is the largest in terms of volumes of trades and quantities of dollars involved. Again, each stock exchange is merely a collection of brokerages that have gotten together to create a standardized system to trade. Government agencies have been formed to regulate the activity of the stock exchange, to help protect people from getting completely wiped out financially, and to help prevent criminal activities from occurring within the arena of stock trading. There are numerous ways to trade on the stock exchange now, with access to the most common person simply creating an account on Robinhood or E-Trade or some other brokerage platform and to start buying and selling shares or other derivatives of shares. There has been a massive upsurge in these at-home traders called retail traders in the last 10 years especially. This is due to internet and from social media bringing the ability to do this to light, and the ease of brokerage signups through tech advances. This has changed the playing field dramatically. Sadly, most people lose money in the stock market, and in fact, it could be said that the stock market is a way for institutions to suck up even more money from the common person across the land. Warren Buffett said this: "The market is a device for transferring money from the impatient to the patient. Discipline is the toughest, yet the strongest tool in trading." Imagine a vacuum hovering over the US, gliding along and sucking up money from the good people of this land of the free. That's what the end result of the stock market is, unfortunately, unless you happen to have an edge, a hack, to beat the system. You best just put your money into an index fund and never touch it. Otherwise, your chances are about 80 to 95% that you'll lose heaps. That said, the stock market can be bested. And as the founder of the 20-Minute Trader team, I believe we have accomplished this. I would love to hear your viewpoint on successful systems that have worked in the stock market, what you think is the best way to take advantage of it. And if I said anything in this video you disagree with or agree with, I would love to hear. Like and subscribe for more clear and fun content. And don't forget to click the link below for the full 20-Minute Trader strategy fully described.